but any appreciation on what you paid for the asset would be tax-free. No taxes at all. Hey everyone, Kevin A. Malsh, Pine Financial Group. We work together so you succeed. If you're just stumbling across a video or if you've been following us for a while, hit the subscribe button and maybe hit or mash on that notification button so that you get notified each time we have brand new content coming out. We're working hard to bring you fresh content, and today is no exception. We're talking about big tax savings with opportunity zones. You know, we get calls pretty frequently. I'd say about 1 or 2 a week with clients and potential clients asking us about opportunity zones and how they could benefit from this. And it's very interesting because it's not as attractive to a simple mom and pop type investor like myself or maybe most of you. There's 2 real benefits to the opportunity zones, and let me actually take a step back and explain what this is. The federal government wants to create jobs, they want to create growth, so they've asked that each state identify different zones of opportunity, okay? Now this could be for, let's say it's in the zone, it could be for businesses, it could be real estate, but there's some specific things you have to do to get the tax benefits, okay? First of all, you have to be in the opportunity zones. We'll put a map up in the comments, a link to a map in the comments so you can see where these opportunity zones are in your area. But here are the 2 benefits. Number 1, it's very similar to a 1031 exchange where you could defer taxes on the sale of an asset. But the benefit here is it does not need to be a like-kind exchange. So it doesn't need to be a piece of real estate for another piece of real estate to defer taxes on it. It could be you had some profits in a stock market or profits in a business or something else that you could sell for a gain and you could defer the taxes all the way until 2026. So this is how it works. Let's say you have a $100,000 gain. Maybe you sold some stock, okay? If you were gonna pay the capital gain on that, the long-term capital gain on that without the opportunity zones, you would just pay the 20% or 15%, depending on your income level, on this $100,000 gain. Now, if you want to roll it into an opportunity zone and you hold the asset for 5 years, you can reduce this gain by 10%. So you would only pay on a $90,000 gain instead of the $100,000 gain. I think this is one of the myths out there is you're gonna get a 10% discount on your taxes. It doesn't quite work that way. What it is doing is reducing the gain by 10%. So you're paying taxes on a lesser amount. Now, let's say you hold it for 7 years. Then you're gonna reduce this gain by another 5%. So it'd be a total of 15%. So instead of the 90,000, you would actually be paying on only 85,000, and this would be again in 2026, tax year 2026. So in 2027, you would finally have to pay the gain on this $85,000. Okay, so the benefit, of course, is the deferral and the reduction in the amount of the capital gain. The other big benefit, and this is what is getting people really excited about it. If you hold this asset for 10 years, you're gonna have to pay the gain on the 85,000, but any appreciation on what you paid for the asset would be tax-free, no taxes at all. So if you buy something for $1 million, let's say, and you're putting a 10% down, that's where the 100,000 comes from. Let's say it's a $1 million asset that goes up over a 10-year period. On average, it might be a 7-ish% appreciation. Let's just use that to keep the math simple. Now we're at a $700,000 gain. Okay, we started with a $1 million asset. We're gonna sell it for $1.7 million after 10 years. Simple math, $700,000 gain, tax-free. Okay, what are the myths? I'm not gonna need the help, fellas. I got the math right on this one. What are the myths with the opportunity zones? The first one is that I can roll in my capital gain into this number here after 10 years and not pay any taxes on the gain. So let's say I'm going to sell a piece of real estate and I get a $50,000 capital gain. I could defer that like we talked about up until 2026. I cannot, even if I hold the asset for 10 years, avoid paying capital gain taxes on that asset. It's only on the current asset inside the opportunity zone. Myth number 2 is I just buy a rental property and I'll just hold that for 10 years, and then after 10 years I'll sell it, and whatever the capital gain is, I won't pay any taxes on it. It's not quite that simple for 2 reasons. Number 1, in order to qualify for any tax incentive at all, the property or the business does need to be in a zone, that opportunity zone. Also, you need to invest in that zone through what's called an opportunity fund. So you have to put your money into an LLC, corporation, something that gets taxed as a corporation or a partnership, and then that has to go into the opportunity zone to qualify. So that's number 1. It makes it a little bit more tricky. Number 2 is when you buy a property through the opportunity fund in an opportunity zone, the initial use of the property has to be at the same time the fund was created, would be check number 1. So that's basically building something from ground up, right? Or there has to be a substantial improvement to the property to qualify. A substantial improvement has been a little bit tricky to nail down because there hasn't been a lot of information about this, but the information has come out now. In order to qualify for substantial improvement, you have to improve the property by the same amount as you paid for the property over a 30-month period, anytime in the 10 years that you own it. So you just pick some 30 months and you have that much time to reinvest the same amount as the property cost. But it does not include land. So let's say, maybe this will be easier if I write this down. I'm not sure how this will go, but let's say you buy a piece of property, and let's keep the math simple, for $100,000. Okay, first thing we got to do is take out the land value so we can get the property improvement value alone. So I go to the county website, see what the county assesses the land at. Let's say it's $20,000 for the dirt. That means I have $80,000 basis in the improvements on the property in the opportunity zone. So I need to spend $80,000 over a 30-month period in order to qualify for substantial improvement and qualify for the tax incentives. I hope this helps you understand a little bit more about the buzz on the opportunity zones and how you may or may not be able to benefit. We might shoot another video in the future on some strategies on how to actually get involved in this. But you can see it's really targeted at the bigger dollars coming out of the stock market and sell of businesses into bigger development projects. Hopefully you liked it. Hit subscribe below and check us out at pinefinancialgroup.com.